Right now, we want to talk a little bit about treasuries because investors ran for the exits today, selling stocks and scooping up the safety of U.S. treasuries. And that pushed the yield on the 10-year treasury below 2% at one point, a record low. We all were kind of scratching our heads because we couldn't believe it had gone so low. Megan McClellan is head of fixed income strategy at JP Private Bank, which manages $776 billion in assets. Meg, good to have you here on Street Smart. So a record low, but it feels like we keep saying that when it comes to the treasury trade, particularly that 10-year. Do we go lower from here in your view?
That's a great question, and thank you so much for having me here today. So if you look at the traditional safe havens, it's gold and it's been treasuries and it's been the Swiss franc really in the recent risk-off markets. I think the answer is it depends. It's a very volatile summer. We're not going to see a lot of firm conclusions until we get some direction out of Jackson Hole later this month. And also the Europeans return from vacation to take control of that situation.
You mentioned Jackson Hole. What do you think? Are we going to get something out of Jackson Hole? You know, we've been hearing from various Fed members who dissented in the last Fed move, and some are saying, well, the economy is going to get better in the second half and that maybe we're going to actually see interest rates rise before we expected. So what are you expecting out of Jackson Hole?
I think it depends. You know, personally, the way that we look at the interest rate markets and we think about pricing in QE3, it's almost like you got a QE3 for free with the last Fed meeting. So when the Fed decided to peg interest rates for the next 2 years,
by telegraphing
exactly,
so far out.
Exactly. So by telegraphing that kind of slow growth, they almost got a QE3, driving the 10-year yield down to, as you said today, below 2%. So you may not necessarily need any additional policy action.
Meg, how much are the Fed's hands tied by the dissenters? And it's not just the dissent, but the sort of level of dissension has been, I think, pretty amazing. Sort of the talk out of school has been pretty amazing. And also, if we see inflation start to kick up a little bit, is the Fed then left at a loss as far as policy moves?
Yes. So I think that the Fed is going to be a little bit at a loss. As we saw the inflation data today, the headline inflation numbers came out ahead of what was expected. Core inflation is still relatively well contained, but definitely ticking up. So in that respect, I think the Fed's hands are a bit tied. And as you mentioned, the dissent, again, that really is unprecedented. So when we look at those dissenting voices, and particularly the strength with which they spoke today about not wanting a so-called Bernanke put on the stock market, I do agree with you that the Fed's hands may be somewhat tied here.
Meg, what are you advising your clients? I mean, we mentioned you guys have almost $800 billion in assets under management. Treasuries have done fairly well for investors as of late. I mean, are you still telling your investors that's where they should be?
When we look across the fixed income markets right now, we're really looking at the strength of corporate balance sheets versus the public sector. So really looking to the private sector for investments. So specifically in the higher quality corporates, financials have had a huge pullback, as you've seen in the stock market. That's also true in the bond market. So we think there's some very attractive opportunities and very high quality financials for investment grade credit.
Wait, so I'll take that as a no. You're not advising investors that they should be moving into the Treasury trade?
No, you know, we didn't like the risk reward in the Treasury market 6 months ago with yields 100 basis points higher. So here, to get a 2% yield, I can buy a 6-month piece of corporate debt and really beat that yield for a company that's cash rich with very little leverage. I'd much rather do that in the corporate market.
Do you indeed short, Meg, treasuries and then buy even high yield debt out here?
That's an interesting question. I think the summer volatility would make that a very, very difficult trade for the next couple weeks, but that's definitely worth watching as we get a little bit resolution around the situation in Europe and also some more economic data out of the United States.
All right. So as we wait for economic data, I mean, are you guys banking on a double dip here at this point, or are you just going to kind of wait and see here?
You know, we're really not, our house view is not that there will be a double dip here. We're very, very closely monitoring the data. You know, it's been mixed. And, you know, I think really where we're looking for opportunities is rather than betting on an outcome where you're seeing kind of 50-50 priced into the markets now of a double dip. You know, we're really kind of trying to leverage the strength of corporate America rather than looking to the public sector for investment ideas.
You feel like that's safer?
Yes, at these levels, absolutely.
Meg, we got to run. Thank you so much.
Thank you for having me.
Meg McClellan, she's head of fixed income strategy over at JP Private Bank.